Welcome to this session hosted by the Blockchain and Digital Assets Working Group of the Hellenic Association of Treasurers. We're extremely happy to have with us today Professor Georgios Samakovitis for an in-depth discussion on the various perspectives on the capabilities and affordances in CBDC initiatives globally, and specifically around the impact and ramifications on policy and regulation. A brief introduction for our guest. Georgios Samakovitis is Professor of Fintech and the Deputy Head of School of Computing and Mathematical Sciences at the University of Greenwich. He has been a member of various advisory groups and expert panels, and more recently, a member of the Bank of England Technology Forum, advising UK Central Bank on the design and development of the digital pound. Now, without further ado, I will hand over to my guest, George, for his presentation.
All right, thanks very much, Panagiotis. Thanks everyone for making it to this discussion. As Panagiotis said, I'm a professor of financial technology. I've been involved in the Bank of England's CBDC initiative, and especially as member of the Technology Forum and I'm working in two of the working groups. The one is on privacy, and the other one is on the design of the core ledger. I have to start by a disclaimer and saying that anything I say today is my personal views. It does not in any way reflect the views of any organization I am or have been associated in the past. It is grounded on the back of my involvement and experience all these years with payment systems and with the development of CBDCs. And I am hoping that this will, as I said before, motivate the conversation at the higher level. So I have chosen to name my my presentation under that title because I think that it is really, and the way I see it is that central bank digital currencies do offer this opportunity for for investigating and looking into how the capabilities and affordances of technologies, in particular blockchain, but not entirely always, and I will explain what I mean later on, gives a good step for the redesign of infrastructure and the development of what is known today as digital money. So essentially, we have seen, and all of us who are involved in this area have seen all the initiatives. We have seen already the launch of certain of the central bank digital currencies in places like the Bahamas, in places like Nigeria, where central bank digital currencies are already in operation. In admittedly, smaller jurisdictions and more experimental, at the more experimental level, but we have seen the major economies, the UK, of course, the EU with the digital euro, as well as the Federal Reserve, launching such initiatives. We know that the Chinese government has issued the central bank digital currency, and although it is its infrastructure is more around a centralized model. It's still is a model that is in operation. Now, it's important here to stress the fact that despite we are looking at CBDCs as the opportunity for many of the affordances of distributed ledger technologies to be put to work into, well, as I said, digital money, programmable money, or whatever other form money may take, it is not a constraint. There are considerations, and there have been considerations around other sovereign economies, including the UK, including, of course, the EU and other national economies, that the possibility exists for centralized and not distributed solutions for reasons of control and for reasons also of energy efficiency to operate. However, so this is only, if you like, a disclaimer to say that, yes, when we are looking at central bank digital currencies, we nearly automatically think of blockchain, but this is not, necessarily a constraint about the implementation framework. So we are familiar of what are CBDCs, and I don't want to, just spend too long into that. But it is that interface that we need to look at, that interface between the fiat money, what is considered as money by the central banks, and the digital infrastructure. There are many motivations that we have seen and are being discussed as to why we need to issue them. Some of them, and the more if you like, the more prolific ones have to do with banking the unbanked or the underbanked. It is about replacing or very often augmenting cash. So in a way, creating interfaces on that carry exactly the characteristics and affordances, including anonymity, of the physical cash that is in circulation, but not necessarily to replace it. There are seen as instruments to introduce monetary policy, but also motives. There are significant motives to introduce techniques for more instant clearing and settlement of transactions, but also to support anti-money laundering, counter-terrorist financing attempts, which is admittedly one of them and the major use cases that we have seen, and there are a number of different characteristics. But if you like, and that is one of my favorite diagrams there, coming from the Bank of International Settlement. The way that CBDCs are projected is one where they appear to be sitting in the interface between between currencies that are issued by central banks, are digital, are widely accessible, hence, the banking the unbanked or underbanked, and also they are token based. So in a way, all the CBDC projects that we have seen so far are very often viewed as what you see on the right-hand side of your screen. And again, I'd like to invite you to think about potentially what, in addition, what additional capabilities or additional affordances one can think of. So in a way, as I said before, it's an augmented cash equivalent, in a way a complement to cash. That means that central banks are not thinking of CBDCs as necessarily a replacement for physical cash, but as an additional form of currency that will be used to complement. There are a number of reasons in the conversations in central banks globally about why this may be a more effective approach than a total replacement, one having to do with access to finance, which is an important consideration, especially if we, in combination with digital literacy, with connectivity, and other accessibility matters. There is a significant contingent that looks into the capability to improve anti-money laundering and customer due diligence. In many ways, as I will say a bit later on, that there is a certain trade-off between the traceability of funds when we are addressing central bank digital currencies or digital money, in effect, between privacy and traceability. So, that trade-off is at the epicenter of many of the discussions concerning design, the models of implementation. But there are also seen, and for me that is the most important feature, they're also seen as opportunities for modernizing policy and regulation. They are seen, and I put that in bold at the last bullet point in my list. They are seen as an opportunity and a clear demarcation between money and crypto assets. Essentially, what I mean by that is that, and especially with reference to decentralized money and applications of DLTs and blockchain applications for central bank digital currencies. The combination of the sovereign money, what is backed by the central bank, and the capabilities that we have seen all these years through cryptocurrency use cases, digital assets, crypto assets, and so on. The combination of the two is, in a way, pushing, if I am allowed to use the term, cryptocurrencies into the asset-only class. So turning them into digital tokens that may have all sorts of, they may be considered as digital representations of assets. They may be considered as a decentralized stock or anything else other than money. So in a way, CBDCs are the way in for governments, for the central bank, into the capabilities introduced by blockchain affordances, and in order to clear, if you like, the landscape. Of course, that may seem, for many as a far-fetched scenario, but in many ways, it's it's one of the critical developments there. And it's also, I see that as a test bed for new exchange infrastructure. What is being looked at in CBDCs now, which is a limited use case of how can we turn all the capabilities that we have with physical cash into a digital equivalent, a digital twin for cash. It is also the opportunity to build the programmable money that will be usable. So in a way, rewiring rewiring the financial system globally, but that cannot be done overnight. That requires a lengthy process. And speaking of lengthy processes, I would need to go. I will talk a bit further down about the some of the historical characteristics of the developments around CBDCs. So a bit more information about the a bit more insight, if you like, about the affordances of CBDCs. And the motivations in terms of achieving financial stability, in terms of supporting monetary policy, financial inclusion that I mentioned before, and so on. We have seen from the applications of CBDCs which have already happened. We have seen, for instance, the Bahamian sand dollar, finding that striking, if you like, that use case of allowing transactions in rural areas and in places where access to cash, access to ATMs has been limited. So again, some food for thought about the affordances, the capabilities, and the motivations behind the central bank digital currencies. Now, what I thought is interesting in terms of the structure of the structure and the functioning of CBDCs is to look a bit into their modalities. And there are, while I will not stick around for too long into that, I think it is useful to make these these clarifications and these distinctions, that CBDCs have been looked at under the four modalities: the one of settlement, token, policy, and account. And you can see in what way these are different. What that tells us really, in terms of infrastructure, but also in terms of affordance, is that there are multiple ways that central bank digital currencies have been promoted and have been looked at as solutions for all sorts of different problems. One of the interesting ones is the policy modality, the interest-bearing central bank digital currencies, but also what is important to make the distinction between is the infrastructure models that can be used or have been used in numerous use cases, and they are still being considered between the bearer token model and the wallet model. So central bank digital currencies, and again, having to do with how close to cash they may, or how close to cash we want them to be, may take the form of money in wallets through, and transacted through the API economy, or, well, again, transacted through the same economy, but may take the form of bearer tokens, so without the need of the wallet. So there are, in addition to these four modalities that we are presenting here, there are also infrastructure modalities. And the reason I am mentioning all these parameters is to start appreciating, is to allow us to start appreciating the complexity in the nature of the problem and the way that it has to be looked at and treated. So again, just for a bit, a couple of things about operating principles. We know, and these are, mostly definite criteria in terms of, issuance, minted, they are minted in the same way as other cryptocurrencies. They may be based on private or hybrid blockchain. There is the capability to regulate the supply, but again, all these features will also be considered in relation, as you will see later on, in relation to privacy models, in relation to other infrastructure requirements. So everything that you see on your screen, and I do apologize for the diagram reflecting a blockchain-based model for CBDCs. As I said before, this is not the only model that can be used. There can well be centralized solutions, and in many ways, centralized solutions may also be more efficient in terms of a number of features and characteristics. But the possibilities for governance, for instance, are being considered, where the infrastructure operators may have to be private, or may have to be federated, may have to come as an association, as a third party, or as an association, as I said before, between different organizations. And of course, there are the trade-offs between anonymity and traceability that I hinted on before, and the aspects of trust and data protection. And I will get to that when it comes to looking into how different economies, or different working groups and different contingents across jurisdictions have started approaching the problem of central bank digital currencies. So that brings us to a bit of history. We can see that there has been a point at which momentum has been gained. That comes from a very interesting source provided by the IMF called the Ascent of CBDCs. So if we look into the number of central bank digital currency initiatives launched in 2018, 2020, 2022, and the one that you will see in my next slide, which is a snapshot of the current state of play, we can see that the momentum has been increasing. And one of the reasons, of course, for this, this interesting trajectory is the fact that sovereign states have started also considering interoperability, and they have started considering how they are going to start interacting, how they're going to bridge the different digital currencies that the individual sovereigns will build together. And at present, I believe there is a large number. I think there's about 30 different projects for in flight for interoperability between central bank digital currencies of different countries in different jurisdictions. So this is the state of play today. You can see that there are more than 130 CBDC initiatives at different stages. Interestingly, we can see that there are a few that have been cancelled. In effect, the one in Kenya, well, the one in Ecuador has been considered as a failure and was decommissioned. The one in Kenya was, if you read the the relevant publications of their central bank, was put aside for a period until potentially more maturity is gained. But we can see that the global economy is moving towards implementing more and more at different stages central bank digital currencies. And as I said before, that also hints to that idea that this is a preparation, if you like, for potentially in the next 20 or 30 years, the rewiring of the global financial infrastructure. There is a lot of learning that has come in the past 10 years from the space of cryptocurrencies, of crypto assets. In a way, that decentralized finance space and all the technological developments that have been happening can be considered in a way as a sandbox for that rewiring of the future economy. So what they offer, and I think it is useful to look at a couple of characteristics around central bank digital currencies before we get into some of the design considerations. And I'm starting from the opportunities that they offer, and starting, from the top, the fact that they are allowing frictional payments, instant settlement, although the question of finality is quite burning, and that also has to do with different jurisdictions and how they are going to be assigned, and the legal framework will play a critical role into that. They promise, the technological promise comes also with the promise of minimal or eliminated or no transaction fees, so allowing frictionless payments, the security and transparency, the fact that that CBDCs can act as complementary and not replacement assets, so not doing away with physical cash, but complementing digital cash as an anonymous way of payment. I will return to that concept of anonymity in a while. But also, they offer the affordance and the capability for cross-border and that cross-infrastructure functionality. Now, the risks that that it comes with is that is the same level of risk as we have with any technology that has not been tested at that level, in the sense that the risks introduced by the fact that as a government, as a central bank, you are introducing a format that has not been approved, that has not been tried and tested, and it introduces a number of risks, cyber risk, and trust is very sensitive at a very sensitive level. Also, there are significant design complexities, and of course, very often there are operational conflicts as to how especially concerning interoperability. When it comes to assessing the efficiency of and the operational efficiency of central bank digital currencies, I think it's important to consider the scalability trilemma, the one that we are seeing. That many of us are very familiar with, that trade-off between security, scalability, and decentralization. And this is one that we will keep revisiting when we look into the operational primitives of the applications. it's important. One of the caveats, and I think we had a very interesting conversation just before this talk with Panayotis, and we were talking about the constraints. What are the major constraints in implementing all these solutions? And we were saying, well, the legal and regulatory framework is one, but also acceptance is significant. What you see on your screen is a snapshot from the Bank of Canada survey in 2023. And it's looking into the top features that are ranking as they are ranking by importance. The Bank of Canada did a consultation, and what you see is based on approximately 90,000 responses from a variety of stakeholders. And where I would turn our attention is the right-hand side, where we can see the mapping of trust, or rather the absence of trust in organizations holding data and privacy. So we can say that there is an overwhelming majority of respondents said that they completely distrust the organizations that are handling data privacy, including central banks. And this, while this comes from from the Canada use case, it has been reflected across all sorts of different analysis. One of the more complete analysis comes from the CFA Institute that was done last April, so nearly a year ago. Actually, the data comes from precisely a year ago, and we can see that the public perception, how the public perception promotes or reflects a generational divide. So we can see that the younger generation has a better understanding of CBDCs or appreciates, how they operate, but overall, we can see that there is a tendency on the right-hand side of our diagram for shifting attitudes towards private money. So the distrust towards private money is increased, and therefore that also gives us the opportunity for central banks to move towards this space and populate the space, with the with money that is grounded, that is guaranteed by central banks. So I thought that this statistical picture would be relatively helpful in providing some insight about the how the public perception on trust, and how a reflection, if you like, of the digital literacy, which may be associated with the different age bands that you see in this diagram, reflect the acceptance of CBDCs. Remember, one of the reasons why I'm mentioning that, and I'm taking you through that statistical journey, is to make the point that at the end of the day, it is about the acceptance. What CBDCs will be a successful project if they're being accepted and used by the end user, not just the central bank. And we can see again the different modalities for CBDCs, and the difference here on the bottom right-hand side of the slide that you see has to do with the guaranteed of payment completion, or in other words, the aspect of finality. More about finality right here. So, based on what, at least as I said, this reflects my personal opinion and my personal understanding from the different CBDC projects that I have seen and reviewed in the past year or so. The common areas of analysis across all sorts of different projects can be summarized under these basic four headings. These four headings are not far from the way that the different groups of expertise have been set up. So these are the model design, the privacy design or privacy considerations, the design of the core ledger as part of the model design, but also as a distinct element, and the role and the definition of the roles of the payment interface providers, the payment systems providers, the third parties, and overall the ecosystem around the handling, management, settlement of central bank digital currencies. So we can see, and I've highlighted some of these terms, which by looking we can start appreciating some of the complexity there. First of all, the level of flexibility, the difference, the level of flexibility in whether CBDC models will accommodate, will support a platform model only, so a wallet model, or a bearer token model. Remember that if we are looking at replicating the functionality of cash, if we are looking into translating the precise affordances of the cash that you have in your wallet to a digital twin of it, the models that we should start considering may be completely different than the ones associated with bank accounts. So there are initiatives that are looking into how bearer token models can work. There is, and that is one of the aspects that I will also touch on later on, the side of the ability to fulfill offline payments and the concept of transitivity in the sense of whether once an offline transaction is performed, a user is able, and to what extent, to reuse these offline or these assets which were transferred offline before they connect, on the internet, and that is very important in rural areas. So the use cases for transitivity may be more important in certain jurisdictions than others. So if we think, for example, the demographics, the geographical and network coverage in areas like Australia, the problem of offline payments is a lot more acute than it is, say, in the UK or in most of the urban areas. So the demographics density, the velocity demands, how quickly the transactions should happen are playing a critical role. And as I said, again, that is also contingent to jurisdictions. The very important feature is that of transaction finality, the settlement, how quickly they are settled and how final transactions are. And that is also tightly associated with the design of the core ledger. What should the core ledger of the central bank, what should it carry? What sort of information should carry? Always bearing in mind the privacy considerations. And there are other features like, the throughput. There is the threshold that is being considered as a minimum, which is approximately 30,000 transactions per second, which is considered, as I said, the bare minimum. And in distributed ledger solutions, these may be, while the centralized solutions can reach numbers of transactions which are much higher than that, distributed ledger solutions with the introduction of of layer 2 and other similar technologies can achieve that. So we can see that the technologies are moving towards towards this direction. And also when we look into the privacy considerations, the aspects of persistent privacy and the building of systems that, and remember the blockchain trilemma I mentioned before, the relationship between how you can achieve scalable systems while maintaining the requisite privacy, and all these requirements around functionality and compliance. I mean, I did mention the aspect of offline payments, and over there is a privacy considerations between offline payments finality and whether you as a citizen can remain anonymous when you're performing offline payments, and the trade-off there is that in order for the central bank to prevent against double spending for one, or to ensure that the asset custodians are the ones who say they are, potentially that may have to come with a compromise in privacy. And finally, one of the more critical areas, one of the more important areas, is to define in the design of the central bank digital currency what are the roles within the ecosystem. What is the who owns certain processes, who is responsible for AML or counter-terrorist financing compliance, the processes for funding and defunding the wallets, how are disputes resolved, and so on. So there is a large number, and I appreciate I have spent quite long on this slide, but I think it kind of epitomizes the complexities associated with design of CBDCs. And of course, one of the main, and the one you see over here comes from the European Central Bank. One of the main concerns there is how CBDCs are able, or how they enable the handling of anti-money laundering. And the main problem here is, how do you marry up the promised anti-money laundering capability with privacy? Are we looking into money that is not private by design, but is it operates through a platform that introduces privacy as a feature that can be revoked? Or are we designing a currency that is anonymous by definition, and therefore we need to find alternative approaches to ensuring anti-money laundering? It's not an easy equation to crack, and potential solutions such as the one incorporating anonymity vouchers are in play in different designs. The real test here is how quickly the regulatory jurisdictions will react and will come back with viable solutions. And unfortunately, I believe we will not be able to have a definite conclusion to that until we see the models operating in real life. So I will stay for a bit, and I'm approaching towards the end. And I know that there's been a lot of information, a lot of high-level information here, but I wanted to stick to that for a bit. Some of the cash properties that I think are very important. What you see here is a snapshot from, again, the Bank of Canada. And the reason I'm coming back to the Bank of Canada is that that was one of the first that have done this thorough investigation, and precisely because of the demographic and geographic particularities of their land, to look into settlement, offline settlement of cash. So what are some of the ramifications of CBDC, of the characteristics of CBDCs as what one can call smart cash? Is that it can afford it can allow and afford the instant or asynchronous settlement capabilities it can introduce this auditability, so in a way allowing this capability of full repatriation and counter double spending, but also it depends, as I said before, on the transitivity requirements. So whether we're able to reuse funds in the absence of connectivity, and that is quite important for that is a very important functionality feature in areas where connectivity is very sparse. If an underbanked citizen is unable to use their central bank digital currencies, their digital cash, in the absence of connectivity, then that may be a significant blocker in its use. But it's also, a matter of the usefulness of these use cases are contingent, as I said before, to the geographical density and other other requirements of the particular economy. For instance, as I said before, offline capabilities may not be critical. They may not be considered critical requirements for the European Central Bank, for the Fed, for the Bank of England, but they will be considered as critical in areas like Canada and in areas like Australia, as they are. So again, that motivates a bit of a discussion as to how the cash digital twin can be put to work. So I've gone a long way by introducing some of the historical features, some of the technological features of CBDCs, just to draw to a conclusion about the implications for regulators. And I think that's more of a set of points to motivate the conversation. The areas that I wanted to stick to here have to do primarily with the fact that one may consider CBDC projects as opportunities for engaging decentralized finance ecosystems. And in fact, there are arguments that give us, the idea that centralized finance, what we know so far as finance, may be partial or limited or if you like, restricted modalities of decentralized finance under, certain assumptions and certain considerations. So that's one. The other one has to do with the, the governance trade-offs. So if we look into one of the major motivations behind the behind the introduction of digital cash, of the the digital pound, the digital dollar, and so on, is the anti-money laundering, counter-terrorist financing. So the governance may take all sorts of different forms, may be a delegated governance in the sense that the governance of anti-money laundering may be delegated to an independent third party or to the banks. It may be centralized, which of course, introduces some challenges to privacy, or it may be federated in the sense that it will for instance, revocation of some of the privacy may only come as a result of a consensus between different transacting parties. And that, again, is one area that introduces some of the functionality from the distributed ledger technologies. But also as I said, the opportunities for regulators are quite important there. But precisely because regulation, we always say that regulation is reactive because the law is reactive, and therefore by nature the regulator is reactive. I think that in many ways the conversation has already started as to whether that reactivity may have to be switched into a more proactive elements, and the motivations for regulators are such that support this view. And one of the reasons for that is associated with the motive for offering accessible finance as a core driver, banking the unbanked and underbanked. So the one point that I wanted to close with is the CBDC projects, as I said before, as well springs of knowledge, in the sense that they may be the gateways towards programmable money and towards new affordances, such as embedded compliance, which is, of course, a topic for a different discussion. But in a way, what we refer to when we talk about embedded compliance is the capability to through programmability to introduce some of the compliance features as on-asset characteristics, as opposed to processes for compliance through anti-money laundering or other compliance systems or regulatory systems. So I hope that was helpful. That was everything I wanted to talk about. And on that note, I would like to close this presentation. Thank you so much for your patience, and invite any questions that you may have.